In 2007, the biggest banks on Earth discovered something terrifying. They could see the crash coming. They could see the homes that would be lost. They could see the families that would be destroyed. And they said nothing. The world went to work. People poured coffee. Trains ran on time. Stock tickers blinked green. Mortgages were paid. Retirements looked safe. Nothing felt wrong. But behind those ordinary moments, a financial weapon had already been fired. Not with explosions, not with sirens, but with numbers. By September 2008, the global financial system was on life support. Banks were collapsing. Stock markets were in free fall. Governments were wiring trillions of dollars into private institutions just to keep the lights on. And while the world panicked, something stranger was happening. The people who caused it were not being arrested. They were not being exposed. They were not being punished. They were being paid. Millions lost their homes, their savings, their futures. But the architects of the collapse walked away richer than before. That should have been impossible. So let's slow this down. Because this story doesn't begin with a crash. It begins years earlier, with something that felt safe, responsible, even smart. A mortgage, a credit score, a loan that promised stability. People were told, buy now, build wealth. Your home will always go up. Banks weren't cautious. They were aggressive. Loans were handed out to people who couldn't afford them, because someone else had already found a way to profit when they failed. That's the part you were never shown, because your mortgage was never meant to be kept. It was meant to be sold, sliced, packaged, and bet against. While families thought they were building a future, Wall Street was building a time bomb. A system so complex that even the people inside it claimed they couldn't understand it. But it worked perfectly for one purpose: turning human debt into machine-driven profit. And when it finally detonated, the losses were socialized, and the winnings were privatized. The public paid, the system survived, and the people responsible were quietly protected. That wasn't an accident. That was design. Because what really happened in 2008 was not a mistake. It was the first time the world saw how modern finance could destroy everything without breaking a single law. And in this story, the crime wasn't stealing money. It was creating a system where no one could be held responsible when it all burned down. This documentary is about that system, how it was built, who it protects, and why the biggest financial collapse in history ended with no one going to prison. Because once you see how the machine works, you'll realize 2008 never ended. It just learned how to hide. For a long time, nothing felt wrong. In fact, everything felt better than it ever had. Homes kept rising in value. Paychecks felt bigger. Credit felt easier. Opportunity felt everywhere. For decades, Americans were told a simple story: buy a home, build equity, grow wealth, pass it on. It wasn't just a dream. It was policy. Interest rates stayed low. Banks advertised mortgages like gift cards. You didn't need savings. You didn't need security. You just needed a signature. And suddenly, millions of people who had never owned anything were told they could own everything: a house, a future, a stake in the system. It felt like inclusion. It felt like fairness. It felt like progress. But something subtle had changed. Banks no longer cared if you could afford the loan, because they no longer planned to keep it. In the old world, a bank lent you money and waited 30 years to get it back. In the new world, They sold your debt within days. Your mortgage didn't stay in your town. It didn't stay in your bank. It was shipped to Wall Street. There it was chopped into pieces, mixed with thousands of other mortgages, and turned into something new. A security. A product. A bet. They called them mortgage-backed securities. Then they made something even stranger. They took risky loans, wrapped them inside safer ones, and sold the bundle as if it were bulletproof. They called those collateralized debt obligations, CDOs, a word that sounded scientific, neutral, safe. But all it really meant was this: your debt had become an investment. Pension funds bought them. Universities bought them. Governments bought them. The savings of teachers, firefighters, and retirees were now tied to whether strangers could make their mortgage payments, and almost no one knew, because on the surface, everything still looked calm. Home prices kept rising, defaults stayed low, ratings agencies stamped these products with ATA labels, the same rating given to government bonds. They were sold as safe as cash. But here was the lie hiding inside the system. Many of the loans inside those bundles were already doomed to fail. Adjustable rates, no income verification, no down payments. People weren't being qualified. They were being harvested. Because Wall Street didn't make money when you succeeded. They made money when you signed. Once your loan was sold, the risk left the bank but stayed with the world. And the system rewarded one thing above all else: volume. More loans, more bundles, more fees, more profit. Whether the loans were good or bad didn't matter, because someone else was holding the bomb. And that raises the question no one was allowed to ask. If these loans were so safe, why did Wall Street feel the need to hide them inside layers of financial machinery? Why wrap risk inside complexity? Why disguise danger as stability? The answer is simple: because the illusion had to hold. As long as the market believed everything was fine, the money would keep flowing. And as long as the money flowed, no one would look too closely at what was really inside. But behind the rising home prices and smiling commercials, a structure was forming. So fragile, so leveraged, so dependent on endless growth, that the moment reality touched it, everything would collapse. And when it did, it wouldn't just take down banks. It would take down lives. By the time anyone realized something was wrong, it was already everywhere. The collapse didn't start on Wall Street. It didn't start in a trading room. It started in living rooms, kitchen tables, pay stubs, loan applications. Banks began offering mortgages to people they knew could not afford them, not because they believed in them, but because the system paid them to. These were called subprime loans: higher interest, hidden fees, exploding payments. They were sold to people who were desperate to belong in a world that had been built to exclude them. And once those signatures were written, those loans were gone. Sold, bundled, resold. Thousands of fragile mortgages were stitched together and shipped across the globe. To Europe, to Asia, to pension funds, to retirement plans, and every step of the way, they were labeled safe. AA, the highest possible rating, the same grade given to government debt, a promise that nothing could go wrong. But something was already going wrong. Inside banks, loan officers were being pushed to approve anything. Income didn't matter. Savings didn't matter. Even jobs didn't matter. The more loans they wrote, the more bonuses they earned. On Wall Street, Traders were betting on one thing: home prices would never fall. Not because it was logical, but because the system was built to punish anyone who doubted it. If you questioned the bubble, you lost money. If you rode it, you got rich. So everyone rode it, even when the data began to scream. By 2006, economists were warning that housing prices had detached from reality. Defaults were creeping up. Adjustable rates were resetting. Families were starting to miss payments. Regulators saw it. Analysts wrote reports about it. Investigators later said the danger was visible long before the crash. But markets laughed, because belief had replaced evidence. The bubble had become too profitable to challenge. And then, in 2007, it began. Quietly, subprime borrowers started defaulting. Not in headlines, not on TV, but in spreadsheets. Small lenders collapsed. Mortgage companies folded. Firms that specialized in risky loans disappeared overnight. And suddenly, no one knew who was holding the bad debt, because it was everywhere. Banks stopped trusting each other. Credit dried up. The system that had been built on endless lending could no longer lend at all. And when lending stops, everything stops. Businesses, payrolls, housing, trade. The world's financial bloodstream was freezing. But the public still didn't know. The news was still calm. The markets still pretended. Because the truth was too big to speak. The machine that powered the global economy was cracking, and no one was in control. If you want to understand how a handful of hidden decisions turned into a global catastrophe, stay with this story, because what comes next is where the illusion finally dies. By early 2008, the illusion was cracking. Not loudly, not in public, inside the system. Banks were no longer arguing about profits. They were arguing about survival. No one trusted anyone. No one knew who was holding the bad debt. And everyone knew someone was lying. In March of that year, one of the oldest names on Wall Street began to collapse. Bear Stearns, a bank that had survived wars, depressions, and crashes, was suddenly running out of cash. Not because it didn't have assets, but because no one believed those assets were real anymore. Traders tried to pull their money out. Partners stopped lending. Clients vanished. Within days, a 85-year-old institution was on life support, and then the government stepped in. The Federal Reserve arranged an emergency rescue. J.P. Morgan Chase bought Bear Stearns for pennies on the dollar. An empire built on risky promises had been handed to another bank with taxpayer backing, and the world was told everything was fine. But behind the scenes, the infection was spreading. Because Bear Stearns wasn't special, it was just the first one to bleed. The mortgage system that had been feeding Wall Street for years was rotting from the inside. Two companies sat at the center of it all: Fannie Mae, Freddie Mac. They weren't banks. They weren't government agencies. They were something in between. And they owned or guaranteed nearly half of all American mortgages, which meant they were holding the heart of the housing market. By the summer of 2008, they were drowning in toxic loans. The government had no choice. They seized them, put them under federal control to stop the collapse from spreading further. This was no longer a Wall Street problem. It was now a national emergency, and still, the system pretended it was contained. Until September 15th, 2008, Lehman Brothers, a 158-year-old investment bank with over $600 billion in assets, was allowed to fail. No rescue, no bailout, just bankruptcy, the largest collapse in U.S. history. And in that moment, the financial world froze. Markets around the globe plunged. Banks stopped lending. Companies couldn't make payroll because Lehman wasn't just a bank. It was a node, a hub of thousands of contracts, loans, and bets that connected institutions across the world. When it died, it pulled everything with it. No one knew who was exposed. No one knew who would fall next. Trust vanished, and when trust disappears in finance, money stops moving. The machine that ran the global economy had seized. And what had started as a housing bubble had become a full-scale financial crime scene, because now everyone could see it. This wasn't bad luck. This wasn't a storm. This was a system that had been designed to collapse. And it was taking the world with it. When the system finally broke, the government stepped in. Not quietly, not carefully. With $700 billion. Congress was told there was no choice. If the money wasn't released, the entire global economy could collapse. Banks would fail, paychecks would stop, savings would vanish. So the public was asked to save the very institutions that had caused the disaster. The Troubled Asset Relief Program, TARP. A bailout so large it was almost impossible to understand, and for a moment it felt like rescue. The stock market stabilized. Banks stayed open. The headlines softened. But something was missing. Homeowners were still losing their houses. Unemployment was still rising. Families were still drowning. The banks got lifeboats. The people got water. Millions had been sold predatory loans. Millions had been pushed into default. Millions had been quietly erased. But the firms that engineered it all were made whole. Bonuses returned. Executives kept their jobs. And no one went to prison. That was the betrayal. Not that the system was saved, but that only one side was. Years later, government commissions would publish their findings. They said the crisis was not a mystery, not an accident, not an act of nature. It was predictable. It was preventable. Warnings were issued. Data was available. Red flags were everywhere. Regulators knew. They saw the reckless lending, the toxic securities, the fragile leverage, and they did almost nothing because the system was too profitable to stop, too powerful to challenge. And when the clock finally ran out, the cost was handed to the public. The same public that never voted for this system, never understood it, never consented to it. The financial machine was rescued, but trust was not. And that's why this story still matters. Because the question was never just how the world almost collapsed, it was who was allowed to survive it. When the financial system was rescued, the people were not. Behind every collapsed bank were millions of quiet disasters. Doors that no longer opened, phones that no longer rang, mailboxes filled with final notices. Homes were taken back one family at a time. Not by force, by paperwork. Mortgages that had once promised security became eviction letters. People who had done everything right lost everything anyway. They didn't fail the system. The system failed them. Savings vanished. Retirement plans evaporated. Jobs disappeared. Unemployment surged as businesses closed and credit froze. Parents who had spent decades working suddenly stood in lines asking for help, not because they were irresponsible, but because the world had been built on a lie. Entire neighborhoods emptied. Windows boarded, lawns overgrown, communities hollowed out. And the damage didn't stop at borders. The same financial products that poisoned American mortgages were buried inside global markets. When they collapsed, Europe fell into recession. Asia slowed. Africa felt the shock. Trade dried up, currencies weakened, governments struggled. A crisis born in Wall Street spreadsheets spread into every home on Earth. This wasn't just a market crash. It was a human event. A moment when invisible decisions made in distant offices reached into real lives. And long after the banks recovered, the scars remained. Families never returned. Dreams never restarted. Trust never came back. Because when a system chooses profits over people, the people pay forever. When the smoke cleared, something was missing. Justice. The global economy had been brought to its knees. Trillions of dollars had vanished. Millions of lives had been torn apart. And yet, almost no one went to prison. The executives who approved the toxic loans, who packaged the bad debt, who sold lies as safe investments, kept their wealth, kept their titles, kept their freedom. Some even kept their bonuses. The system protected its architects and punished the world. Families lost their homes. Workers lost their jobs. Communities were erased. But the people who built the machine that caused it all were quietly allowed to walk away. That was not failure. That was design. Because the financial system had one rule stronger than all others: never punish power. In the years that followed, laws were passed. Regulations were written. Oversight was promised. Banks were told to hold more capital. Traders were told to take less risk. Markets were told to behave. And for a while, it looked like change. But the structure remained. Debt was still bundled, risk was still hidden, profits were still privatized while losses waited for the public. The same incentives that fueled the crash were never truly removed. They were just renamed. So the question still hangs in the air. If no one was held accountable, did the system really learn anything? Or did it simply learn how to survive its own crimes? This was not just a market crash. It was a system revealing itself. A structure built on greed, protected by complexity, and paid for by people who were never invited into the room. What collapsed in 2008 wasn't just Wall Street. It was the illusion that the system was fair. That risk was shared. That power was accountable. It wasn't. And it still isn't. The same machinery that turned homes into bets, that turned families into data, that turned failure into profit, is still running, quietly, efficiently, out of sight. Because the most dangerous systems are not the ones that break loudly. They are the ones that learn how to hide. If you want to understand the invisible forces that decide who rises, who falls, and who gets erased, subscribe, because the next collapse won't announce itself. It never does.